this video, I'm going to discuss the Buffett indicator, what it is, how it's used, and its implications for the stock market. So first, Warren Buffett is the CEO and chairman of Berkshire Hathaway. He purchased the company back in 1965 when the textile business was failing, when he purchased the majority stake that he holds today. In 1967, he began expanding into the insurance business and other investments. He is currently 6th on the Forbes list of wealthiest people with a net worth of $133 billion and is widely regarded as the greatest investor of all time. So the Buffett indicator is a financial calculation used to measure the valuation of the current stock market in the US. This number is going to be a reflection on how cheap or expensive the stock market is at any given time in the United States. So I'm just giving you a heads up. This calculation does have its drawbacks, so I'll be comparing the Buffett indicator with another method of valuation in the United States towards the end of the video, just for referencing. So this calculation was originally presented by Warren Buffett as a percentage of total stock market valuation to GNP, also known as gross national product. So the Buffett indicator is going to be total stock market capitalization divided by GNP times 100. However, it was found that GDP, gross domestic product, was a lot easier to track and calculate than GNP, and they were always within 1% of each other. The only difference between the two is that GNP tracks all international and domestic activity, where GDP only tracks the activity within a country's borders. So if a US citizen earns money from an investment overseas, that would only show up in the gross national product and not GDP. On top of that, GDP gets reported quarterly and also has several revisions throughout the quarter and is a lot easier to track than GNP. The Buffett indicator was then modified to use the Wilshire 5000 as a reflection of the total stock market capitalization. So therefore, the equation was modified to the Wilshire 5000 divided by GDP times 100. In 2001, while the dot-com stock market crash was taking place, Warren Buffett said that this Buffett indicator was the best single measurement of where valuation stood at any given moment in the stock market. So here's a graph using the Buffett indicator. This depicts the Wilshire 5000, US GDP, and total assets from the Federal Reserve, but don't worry about that one. You can see that how the stock market has taken off since the bottom of 22, while GDP has gone up but not nearly as drastic as the overall stock market. Here's another look at the Buffett indicator while compared to the long-term trend line dating back to 1950. Comparatively, we are 61% overvalued as the end of March, and we have been overvalued since quarter 3 of 2013. So right now, the Buffett indicator is approximately 178% overvalued, which is an extreme overvaluation territory. The Buffett indicator is sometimes expressed in standard deviations, and right now we are flirting with 2 standard deviations above fair value for the stock market. This has only happened 3 times since 1951, the first coming in 1968. The first coming in 1968 when the stock market hit 2 standard deviations above the historic trend line. And at the beginning of 1969, the S&P 500 index had a valuation of 102. However, 10 years later, in January of 1979, the stock market was currently at 99. This was a negative return over 10 years, indicating the Buffett indicator's usefulness in tracking overvaluation over 10-year returns. Once the Buffett indicator indicated that the stock market was 2 standard deviations above the historic trend line's fair value, the stock market bottomed in April of 1970, which came 18 months after the stock market peaked at 2 standard deviations above fair value in 1968. The second instance happened in 2000 when the Buffett indicator had a value of almost 160% of overvaluation, where the Buffett indicator peaked in March of 2000. This was the beginning of what's known as the dot-com stock market crash. At that time, tech companies and internet companies were at extreme valuations similar to what we're seeing in AI today and other companies. So just to highlight how overvalued the companies were in the dot-com crash, the top 10 stocks in the S&P 500 index traded at a price-to-earnings ratio, otherwise known as PE, of 60, where the historic normal was around 17. So if you look at the 10-year return from January 1 of 2020 to January 1 of 2010, you can see that the S&P 500 index yielded another negative return, again highlighting how accurate the Buffett indicator is at calculating 10-year returns based on when it peaks when the stock market gets overvalued. After the dot-com crash was complete in October of 2002, the stock market bottomed at 1,114, which was a 78% decline from the top of the stock market when the Buffett indicator peaked at 2 standard deviations above the fair value, which showed a bottom of the stock market coming 34 months after the Buffett indicator peaked. The most recent crossing of 2 standard deviations above fair value came in February 2021, where the Buffett indicator was at an all-time high of 189.5%. While we don't know where the stock market would be 10 years from February of 2021, Warren Buffett once said this regarding stocks and their 10-year returns. For me, the message of that chart is this: if the percentage relationship falls to 70 to 80% area, buying stocks is likely to work very well for you. If the ratio approaches 200%, as it did in 1999 and a part of 2000, you are playing with fire. Since peaking in February of 2021, the stock market bottomed in November of 2022, which came 22 months after the Buffett indicator peaked. After the Buffett indicator peaked in February of 2021, the stock market did not bottom until December of 2022, coming 22 months after the Buffett indicator peaked. So now we're going to walk through comparing the Buffett indicator to the 10-year cyclically adjusted PE ratio of the S&P 500. This is very similar to the regular PE ratio. However, instead of using current earnings data, use the 10-year trailing data of the PE ratio for each stock in the overall stock market to get your valuation. So as shown below, the CAPE ratio is going to be the current price of the stock market divided by the average earnings over the prior 10 years. In March of 2024, the ratio was the third highest it's ever been, only behind the dot-com crash in December of 1999 and October of 2021. In the December 1999 peak, the stock market bottomed 35 months later, and in 2021, it bottomed December of 2022. In the December of 1999 peak, using the CAPE ratio, the stock market bottomed 35 months later, and in 2021, it bottomed December of 2022. Only the dot-com crash reached a ratio of above 40%, while 2021 peaked at nearly 39%. While the current ratio is 33%, the historic average of the stock market using the CAPE ratio is 20%. Again, highlighting that right now the stock market is overvalued. And as of May 10th, 2024, we are currently at 194% overvalued, making the market on the verge of crossing over the 200% threshold once again and putting the U.S. at risk of recession based upon the Buffett indicator's overvaluation calculation. Personally, I'm not really too sure how the markets can sustain this. GDP's coming lower in Q1. We have a revision this upcoming week. Nothing has changed as rates remain high, over 5%. My prediction is that if GDP comes in lighter than expected, we might see a pullback in the stock market. However, if we pull back, we still might end up seeing that the stock market is overvalued, just not as overvalued. But something's got to break in the meantime. The stock market, if you look at the historical trends, it doesn't stay in this overvaluation period for too long. And when it comes down, there's usually a major correction that goes on in the stock market. Right now, fair value for the S&P 500 is 2480. Whether it gets down that low when we do see a correction, maybe not. I think it'd take something to really break in the stock market for us to see that kind of bear market / correction. But we'll see. Anything can happen. We've seen crazier stuff. So what I'm saying is, based on historical returns over 10 years when the stock market is this overvalued, it might be worth your while just to keep your money in a money market account and just wait until the stock market gets a little bit more fairly priced until you make an investment. So I hope this helped. Please like and subscribe, and thanks for watching.